This is a series of videos that help review how we deal with a minority or non-controlling interest. The problems come from another textbook, Hoyle. And the first one is going to be an example where there was no control premium paid, so the goodwill is not going to be distorted. Here's the information. So what I recommend that you do is that you copy the information, or at least as you're watching the videos, stop and work each piece by yourself first, and then try and see how you're doing on that piece. Or another alternative, stop after I do it, make sure that you erase the results, and that you then redo it on your own. So I hope you have your computer in front of you as well as something to watch the video on. Okay, so here's the information. The parent buys 80% of the sub's 100,000 shares on 1-year A for $9.75 per share. And we assume that the non-controlling interest is proportionate, and that would constitute 20,000 shares, and they were selling for the same price. So in other words, the price that the parent or majority owner paid is not higher than the price per share that the non-controlling interest paid. Here's some more information. So here's the book value. And then there are several things that are over or undervalued. Trademarks, patents, the equipment's overvalued, and we need to add to the, well, you'll see how we deal with the long-term liability in a minute. So the first thing we're going to do in our prep work is construct a table to lay out the implications of these trademarks. We're going to do that first. Look at the differences. So in this case, we have 60,000 is a beginning balance in the trademarks. Hold on, let me. The patents, 120,000. The equipment needs to be decreased, and we have 40,000 additional adjustment to the long-term liabilities. Now, what is the implication per year? So these are balances. These are the changes during the year that's going to go on the income statement. So the trademarks are indefinite, so there's no amortization. The patents are going to be 6,000 per year because it's 120,000 divided by 20. The equipment implication, 10,000 divided by 10. That gives us 1,000 per year. And the long-term liabilities are going to affect interest expense over an 8-year period. So 5,000. If we total these up, the additional expense for the year is 10,000. Now, what is the balance going to be at the beginning of year 2? We're going to go ahead and amortize all the way down. So the 120 less 6 leaves 114. The 10,000 minus 1 is 9. The 40,000 minus 5, 35. These amounts are going to be the same, 0. 6,000 minus 1,000. You could just copy from the other one. And 5,000. So here's the next balance. Going down. Oops, sorry. So there's our balances as of the beginning of year C. Let's do a couple other pieces of prep work that's important. Here's some other information. The increase in income in year A And then we have some information about year B, because you'll see that in this problem, we're really dealing with year B. Let's just go down here so you can see. So the trial balance that we're going to use is going to be at the end of year B. So we're going to have to adjust for 1 year. So what else could we do after we've set up that table? Well, we have to look for goodwill. So let's find the total purchase price. Well, that was 100,000 shares times 9.75. That's 975,000. And 80% of that is the amount that the controlling parent purchased, and 20% of that is the amount that was purchased by, or would be, the fair market value of the minority interest. Now we can do it this way easily because I've already said there's no penalty being paid, so there's no distortion of goodwill. Otherwise, you really need to go down the parent by itself and kind of subtract to find what's in the minority. I'm going to do another one like that in a minute. The total amount of up here, book value, 740,000. So that leaves us with 235,000 in excess. That excess can be explained by the fact that we have trademarks that weren't recorded. We have patents that weren't recorded or that are undervalued. We have equipment that is actually overvalued, so that doesn't help. And we have a change in the amount of the long-term liability, which helps explain the goodwill. So if we take the excess and subtract the things that we've explained, going all the way down, we get the total amount, and that's 25,000. If we multiply everything times 80%, that leaves us with 20,000, 80%, and then the 20% is remaining for the non-controlling interest. Works out perfectly. Okay, I'm going to stop. Oh no, I think I'll do one more thing. Let's go ahead and look at equity income for year B, and then we'll look at what's happening with equity investment as well. Notice we do have information about the increase in retained earnings in year A. So if we look at the equity investment and begin with that 780, which is the purchase price, let me highlight that. And then the change in the goodwill, in the retained earnings, the total change, 80% of that affected our, the majority investment. Think about that a little bit if you need to. So we're going to add 56. And then let's look down here at the equity income. Now, where are we going to find total income for the sub? Let's look down here. It says that total income for the sub, before it's been divided between non-controlling and attributable to the parent, is 90,000 We also had that information up above, I think. Let's see. Yeah, here 90,000 and 50,000 in dividends. So 90,000. Then let's go to our table. And our table says that we have a total of 10,000 in adjustments that we need to make. So we're going to subtract 10,000. And that gives us 80,000. Just check. Make sure. Yeah. Now we're going to subtract the total amount of dividends. It's really important that we keep track from now on in totals and amounts that have been distributed to the two parties involved. That leaves us with a change in our total investment, or a change in total retained earnings of 30,000. That might actually be a better title. How much of that is going to affect our investment? Well, because we don't have any issues with distorted goodwill, we can just take 80% straight down. And over here, 20%. So let's see if we can figure out what our investment account would be. Our beginning balance, the portion of year A's retained earnings that we added to our investment. So this is the net of income minus dividends. And we can do the same thing here. Add another 24,000 for year B. And that gives us a final balance of $860. So we're missing one thing. Don't forget that we have to do 80% of that 10,000 up here as well. I forgot that one. So that's going to give us $852. Let's double check and see if that agrees with our investment in sub. Here it is. Perfect. Okay, next time we'll start working through the journal entries to do the consolidation at the end of year B. Make sure you can do everything we've done so far.